Welcome everybody. Just give everybody a few minutes to join. We've got record numbers joining us for the webinar today. I think we've got nearly 600 people, so it may just take a moment or two for people to filter through. So just bear with us until we see the numbers get close to that. Welcome everybody to the autumn budget brought to you on Halloween. I have to apologise now. I can't rule out the team slipping in some Halloween puns as we go through, so do bear with us. Today we will be exploring Chancellor Rachel Reeves' vision for the future, which was encapsulated in her 7 key pillars. These pillars aim to drive economic growth, enhance public services and ensure that the fiscal responsibility. I think it's fair to say that the fear of significant tax changes has resulted in a hive of activity leading up to the budget, with people looking to accelerate plans and looking to conclude transactions to lock into that pre-budget tax regime. I think given that capital gains tax rates, as we will hear in Jordan's presentation, went up with effect from yesterday, I think it's proved that it was good advice to get those transactions over the line wherever possible. So as expected, Rachel Reeves announced several changes in her speech, but also there was always that hidden detail away in the 170-page red book that was released shortly after her speech. We will break down these changes, discuss their implications for individuals and businesses, and provide our insights on how best to navigate the tax changes. One of my frustrations, as always, we don't always have certainty following the budget, so some of these changes are subject to consultation, so it still leaves us with a period of uncertainty, which really isn't helpful in terms of us being able to give clients advice. We know some will be concerned by the changes and heavily impacted, so we will release further details and keep everybody updated as and when further information gets released. We will also bring you further webinars if we think that would be helpful on specific areas. Also, despite the 40 billion tax rises announced in the post-speech media interviews, Rachel Reeves, she didn't rule out further tax rises in the future. She did say it was her once in a parliament budget, so hopefully the significant tax rises are behind us, but again, it's watch this space for future budgets. So that is enough from me. I will now hand over to Jordan Smith and he will talk through the changes affecting private clients.
Brilliant, thank you, Sally. Some spooky surprises announced in yesterday's budget, especially for inheritance tax, which I'm sure many of you will be interested in. First up though, let's talk about income tax. During the run-up to the budget, both the Prime Minister and Rachel Reeves indicated that working people would not be negatively impacted by tax changes, and they have stuck to this, with no changes to the current income tax and employee national insurance rates announced. In fact, plans for a beneficial impact came with the announcement that from April 2028, the previously frozen income tax threshold, thinking personal allowance here, will begin to increase in line with inflation. Now, this means that for the next few years, we will continue to feel the effects of fiscal drag, with more and more taxpayers moving into the next income tax band. But from April 28, we should start to see net wages keep up with inflation. Now, I will note that this timing does take us nicely up to just before the next election, and these changes are not set in stone. So make of that what you will, and we'll have to watch this space. There were, however, some changes which will affect tax-paying individuals, which I'll quickly gloss over now. The welcome plan for high-income child benefit tax reforms to cover household income have been scrapped, unfortunately, which would have benefited many working families. But the government has said that they are going to be making changes to the way that the charge is reported, hopefully to make it easier. Next up, the ISA subscription allowance remains at 20,000 until April 2030. So this gives taxpayers an opportunity to transfer assets into both income and capital gains tax-free wrappers. Next up, enterprise investment scheme and venture capital trust investment schemes remain in place until 2030 as well. This encourages investments in startups, whilst offering investors tax incentives. Next up, making tax digital is still being phased in with the current turnover threshold unchanged. Then finally, interest on unpaid taxes will increase by 1.5 basis points, rising to 9% up from 7.5. So a key drive for the government trying to get unpaid taxes in the door. Moving on to the hotly discussed topic of capital gains tax. As anticipated, the Chancellor has increased the rates, but not as high as those rumoured. The main rates for gains have been increased to match those applied currently to residential property, being 18% for anyone with part of their basic rate band available and 24% thereafter. This 24% rate will also apply to trusts. Now, these changes came in with immediate effect for gains that were exchanged on or before the budget day, and this is going to be regardless of when the gain is actually reported or the tax is paid. This could have a significant impact on those who are in the process of finalising deals, who may now wish to recheck their position to ensure that their net proceeds are what they were going to anticipate being. So these changes follow on from recent drops in the annual exempt amount from 12,300 in 22-23 to just 3,000 in the current year, which is significantly increasing capital gains tax liabilities compared with just a few years ago. For example, let's take a £20,000 gain for a higher rate taxpayer. So if they exchanged on the 31st of October 2022, their liability would have been 1,540. But if they exchanged today for the same gain, their liability would be £4,080, which is an additional 165% in tax payable. The next change is to business asset disposal relief, one of a few changes that is going to be impacting business owners. The current rate of BADR is 10%, and that is going to increase to 14% from the 6th of April 25, and again to 18% from the 6th of April 26, equalising it to the standard rates of capital gains tax. Now, business asset disposal relief is subject to a lifetime limit of 1 million, which is still in place. It was previously 10 million under its entrepreneurs relief guise, which was a hit for business owners back in 2020. So potentially we've got an increase in £80,000 in CGT for anyone selling a business after April 26 compared with earlier this year. There are another few changes which are affecting some individuals. First off, investors relief, which is available for those who invested in trading companies from March 2016, but are not employed or directors, and then sell these shares after 3 years. The rules have been revised from yesterday to equalise the lifetime limit and rates with business asset disposal relief. Then finally on CGT, the rates for carried interest, which is one of the main sources of remuneration for those in the private equity sector, are increasing to 32% from April 25, which is just an interim measure before these gains become subject to income tax from April 26. So now we move on to the rather frightful changes on inheritance tax. So inheritance tax changes were feared, but the impact is less widespread than rumoured, impacting business owners, farmers, and those with significant pension pots. For a high percentage of UK population, there was confirmation that the nil rate bans have been frozen until 2030. Now, what this does mean is that as inflation increases the value of assets within an estate, more individuals will start to breach the available allowances. Therefore, those who perhaps do not see themselves as particularly wealthy may start to benefit from estate planning, even if it's just to get an indication of what their liability might be, to ensure that there's suitable funding within their estates. So one of the key changes which will affect how individuals plan for later in life relates to pension funds. So whilst previously benefiting from an IHT exemption, from April 2027, most pension funds will become fully in scope of inheritance tax, regardless of the age of death or the intended recipient. Furthermore, there have been no changes to the no changes have been announced to the income tax regime on pensions. Therefore, beneficiaries, if they decide to cash in the pension pot, they could have a tax charge both to inheritance tax at 40% and then income tax up to 45% on the balance, which is a massive tax charge, really diminishing the value that's passed on. So it will be the responsibility of the pension scheme administrator to undertake the reporting and the payment of the inheritance tax due on the pension funds. We'll wait to see how the reporting takes place and how nil rate bands will be correctly utilised. We often advise individuals to touch pension funds last when drawing money for retirement. Now, this will likely change with planning opportunities surrounding utilising available income tax bands and potentially exempt transfer gifts to pass on value at an earlier stage. This is especially prevalent as there's been no changes to the tax-free pension lump sums, which were widely rumoured. These changes in pension rules may also see individuals invest in other assets, such as EIS and VCTs, which I spoke about earlier, in order to obtain immediate tax advantages. Now, there was some welcome news with land managed under environmental schemes, such as EMLS, as these will now qualify for APR. But talking about APR, there have been some reforms to both APR and business property relief, which are rather scary. So currently, business property relief and agricultural property relief provide 100% relief from inheritance tax for qualifying assets. From April 2026, the rules which apply to both death estates and lifetime gifts will change, and it's not for the better. So now there is a £1 million cap on assets which qualify for the 100% relief. Then the balance of these qualifying assets will receive a 50% inheritance tax relief, placing an effective rate of tax of 20% on that balance. Now, this change is going to have significant impact on business owners, especially considering the changes to business asset disposal relief, which would increase capital gains tax due if they were to sell up. And it will have significant effect on farming families, which make up a good percentage of our clients. The CLA is making urgent representation to the Treasury on how they think these changes will affect over 70,000 farmers. Where previously succession of APR and BPR qualifying assets has been dealt with on death, these rule changes will see the way that individuals structure their wills and utilise lifetime gifts change, especially considering the unused £1 million allowance cannot be transferred like the other nil rate bands. So again, effective will structuring needs to be considered to make the most. There were no announcements of changes to gift holder over relief on qualifying assets, nor potentially exempt transfer rules, which is a vital part of passing down assets to the next generation during life, which we are going to be seeing individuals utilise going forward. We can envisage farmers who are not fully considering these new changes being forced to sell off small pieces of land to cover liabilities for estates. The longer term impact of food production and land prices will be interesting to follow on this point. If you have been affected by these changes, please get in touch in our team and we can see if we can help. So the next hit for inheritance tax is for shares that are designated as not listed. These are most commonly AIM shares. These now no longer qualify for 100% business property relief, but they do still benefit from a 50% relief. Now, this will impact those who have invested in specific portfolios which are aimed to benefit from that IHT exemption. This is likely to prompt a disruption in the value of these assets at a time where individuals may be looking to get out of them. Now, there are going to be some changes which will affect the trusts as well. Now, the details provided in the Red Book are limited when it comes to trusts. The government will open a consultation in early 2025 to consider a detailed application of the rules for both lifetime transfers into trusts and assets which are already settled in trusts. Now, we'll follow up with more details once they are known, so watch out for that. However, the government has announced and confirmed that trusts set up by the same settler before yesterday will each have their own £1 million allowance, whereas they intend to introduce rules to ensure the allowance is divided between trusts set up by the same settler on or after yesterday, which avoids individuals creating multiple trusts prior to April 26 in order to benefit from multiple £1 million allowances. A couple more changes just to touch on. The government have confirmed the abolition of the non-don status rules from April 25, where it's going to be replacing it with a new residency-based tax system. These rules are really complex, and we'll be looking at them in more detail. So if you're interested in our follow-up comms on these, get in touch and we'll keep you updated. Then another plug for furnished holiday lets. These rules are going to be abolished from April 25. Some of the key implications are the loss of deductible mortgage interest and capital allowances. Furthermore, the loss of capital gains tax benefits, namely business asset disposal relief and holdover relief. Now, we've been having discussions with a number of clients whereby they are selling furnished holiday lets after ceasing trading in order to benefit from business asset disposal relief. Under previous legislation, there was a 3-year window to benefit from business asset disposal relief. Whilst this still applies, people may wish to accelerate disposals to avoid paying at the higher rates of 14% or 18%. Again, we have done a webinar on furnished holiday let changes, which can be found on our website. So next, we're going to move to a poll. If you are, so as a result of most pensions being brought into the scope of inheritance tax, what do we think people will do? Will it discourage individuals from putting money into their pensions, have no impact on individual behaviours, or encourage drawdown on pensions to make lifetime gifts? Just going to wait a few seconds whilst people put their answers in the poll. We're still getting some answers coming through. Okay, so the majority of people believe that these changes will encourage the drawdown on pensions, specifically in order to make lifetime gifts. Now, given that there have been no changes to the pension lump sum rules, this is, as expected. Now, the next decision to make is once you've got this cash, what are you going to do with it? Spend it, invest it in other assets, which perhaps qualify for the 50% BPR relief, or start gifting it if your focus is more inheritance tax related. Of quite a few things to consider there. So next up, I'm going to hand over to Duncan to talk about employment taxes.
Thank you, Jordan. I'm going to be running through the main changes to employment taxes today, and I'm going to start with national insurance contributions. The two big changes are the increase in employers' national insurance to 15% and the reduction in the employer's threshold to £5,000 per annum. These changes are going to be introduced from April 2025. Fortunately, though, there is no employer's Class 1 national insurance on pension contributions. This idea was floated in the media before the budget, so that's good news. As you can imagine, the potential consequences of increasing employers' Class 1 national insurance may include the following: increased costs for businesses, which means lower profits and lower corporation tax receipts for the government. It may also mean lower wage rises for employees and fewer jobs and therefore higher unemployment. But if employers decide to counter the cost increases by increasing prices, there may be higher inflation with higher interest rates. So we must keep a lookout for what happens there. Just to summarize the national insurance 25-26 then, the primary threshold is 12,500, no change until April 28. The secondary threshold is reduced to £5,000 per annum, as I've said. The upper earnings limit for employees is just over 50,000. Again, no change until April 2028. What does this all mean? Well, it means that employees continue to pay national insurance at 8% up to 50,000 and over 50,000 at 2%, and employers over £5,000 are paying at 15%. There is also the employment allowance, which has been increased from £5,000 to £10,500 per year. This can be offset against employers' Class 1 national insurance, but it's only available to employers with Class 1 national insurance below £100,000 in the preceding tax year, and these are referred to as small companies or small businesses in the Chancellor's speech yesterday. Class 1A and Class 1B, which is payable by employers, that is rising to 15%, again from April 25. We come to another poll, and how much do you think is raised in the tax year 25-26 by reducing the employer's Class 1 national insurance threshold and increasing the employer's Class 1 rate? Is it 18 billion, 24 billion, or 30 billion? And we'll just wait a minute for everyone to answer that. Most people have said it's 24 billion, which is absolutely right. And that, don't forget, is 24 billion for 1 year. So over the lifetime of the Parliament, you can work out how much is going to be raised from these measures. I'd just like to go through a few examples which illustrate the impact of these changes. And the first one is, does it mean for a single employee on average earnings for the employer? Well, as you can see there, the gross salary is 36,000. The new employer's threshold is inserted at 5,000. You can see the employer's national insurance for this year compared to next year, and the increase in employer's national insurance of just under £1,000. The next example is for a single director company, where the director annually takes the current threshold, which is £9,100. The new threshold is shown on the right-hand side for 25-26 at £5,000, meaning that £4,000 is now subject to employers' national insurance, and that comes to £615, whereas before it was zero, so the increase in employers' national insurance will be £615. The next example is a small business with 5 employees, each earning £25,000. So this is the effect on the business. So the gross salaries are £25,000 each multiplied by the 5 employees. Again, the secondary threshold for the employer multiplied by 5, giving us an amount of employers' national insurance of almost 11,000 under the current rates compared to 15,000 under the new rates. But then we've got the increased employment allowance of 10,500. So the result is actually a decrease in employers' national insurance payable, and that is because of the increase in employment allowance. The next example is a large business with 200 employees earning £40,000 each. The total wage bill there is 8 million. The secondary threshold for employers is reduced to 1 million. The employer's national insurance is just over £1 million compared to 850,000 previously. There is no employment allowance because the national insurance exceeds 100,000. So we have a situation where the employer's national insurance increases by £197,000. Finally, I'd just like to illustrate the bonus versus dividend question with the new rates. Each case needs to be considered independently, as you'll appreciate, and the decision will depend on the precise facts and circumstances of each case. But generally, profit extraction strategy will be unchanged by the increases in the budget. So for a basic rate taxpayer, we'll be looking to pay a dividend, and a higher rate taxpayer and an additional rate taxpayer a bonus. And I'll show you how that is calculated. So here is an illustration for a director shareholder who wishes to extract net cash of £60,000, and the director shareholder is an additional rate taxpayer. The dividend additional rate remains at 39.35%. The employees' national insurance rate is 2%. Employers is going to be 15%. The corporation tax rate is 25%, and this is for 25-26 tax year. You'll see at the bottom that the net cost to the company of a bonus is 97,000, where the cost to the company of a dividend is 98,000, and the total amount paid to HMRC for a bonus is 37,000 compared to just under 39,000, which confirms that a bonus is preferable in these circumstances. I'd like to now look at the changes to benefits in kind, and starting with cars and vans. Firstly, the benefit in kind for cars is calculated by reference to the list price and the chargeable percentage. Well, the chargeable percentage is going to remain at a maximum of 37% until April 28, then increase by 1% a year from April 28. For electric cars, the percentage is increasing by 1% a year to April 28, and then by 2% a year from April 28. Now on to the emotive subject of double cab pickups with a payload of 1 ton or more. These are currently treated as vans, but their treatment is going to change to cars from the 6th of April 2025. But the good news is that there are transitional measures which apply for 4 years for double cab pickups ordered, leased or purchased before the 6th of April 2025. So if you've got a double cab pickup and it's a van, the chargeable amount per year is just over £4,000 from April 25. And like I said, if you buy your double cab pickup before the 6th of April, it'll be treated as a van for up to 4 years. So you need to consider that very carefully. Turning now to fuel, where an employer provides fuel for private motoring in an employer-owned car, the chargeable percentage based on CO2 emissions is multiplied by a chargeable amount. Well, that chargeable amount is increasing to £28,200 from April 25. And for a van, it increases to just £769. Other changes to benefits in kind. The main one is that benefits will be payrolled from April 2026 in line with previous plans, but this initially excludes living accommodation and employment-related loans, and these two benefits will have a phased introduction. Class 1A national insurance is payable on payroll benefits. There was a fear that it would be Class 1 national insurance, which would be more expensive, but it is Class 1. The official rate of interest for beneficial loans and living accommodation is normally changed on an annual basis, but that basis is being revoked. So potentially the rate can change every quarter from April 2025. So there are 2 planning points emanating from that change. Firstly, ensure that rental agreements for company properties for expensive accommodation provide for rents sufficient to cover the increased interest rates so that there is no benefit in kind. And secondly, ensure that any loan agreements provide for variable interest rates to be paid to the company making the loan to ensure that there is no benefit in kind. I'll now just touch on the national minimum wage, and these rates are from April 25. For workers up to 20 years, the rate, as you can see, is £10 per hour. Workers 21 years of age and over, moving to £12.21 per hour. Finally, other measures which you may be interested in. There are no changes to flexible benefits, which is optional remuneration, or salary sacrifice, which is excellent news because there was a fear that salary sacrifice would be attacked. For employee benefits trusts and employee ownership trusts, there are a number of changes which are being introduced effective from yesterday, the 30th of October 24. And when we get those details, we will publish them for all our clients and contacts to see. As I said earlier, the good news is that there's no employers class 1 national insurance on pension contributions, but on off-payroll working and umbrella companies, there's going to be legislation introduced from April 26 to make agencies or engagers responsible for PAYE on payments to workers. And finally, the national insurance holiday for employers hiring qualifying veterans is to be extended for another year to April 2027. I'll now hand over to Gillian McGill, who will talk to you about VAT changes.
Thank you, Duncan. So we started talking about the possibility of VAT being applied to private school fees way back in February 2024, ahead of the general election. So it's hard to believe that we're now actually facing this happening. We knew a little bit about this before the budget because HMRC released some draft legislation in the summer and also a consultation document on that draft legislation. So before yesterday, what we already knew was that private schools would be required to register for VAT and to charge VAT at 20% on their fees for education and boarding, but with some of those fees remaining exempt where they were in relation to services and goods that were closely related to the supply of education. So the example given by HMRC in their guidance was that that would be school lunches for day pupils. The timing of when schools are going to have to register for VAT, though, is not necessarily from the 1st of January 2025, because as soon as schools start receiving payments for that term, which might well be in November or December, they'll need to be thinking about the 30-day look-forward test for VAT registration, which may well require them to VAT register next month or in December. We do know that schools will be able to recover VAT on their costs, including some pre-registration input tax. So that will be costs that they incurred before they had to VAT register. Now they're subject to certain limitations with respect to time, but that will help schools. And it may mean that for some of them, their first VAT return could be in a repayment position, but will certainly have a much lower VAT bill if there is one to pay. Pupils that are subject to special educational needs or disabilities requirements were confirmed in the summer as still being subject to VAT at 20%, despite some very, very strong lobbying from the sector. However, if those pupils have been placed into a school specified on their education healthcare plan and the local authority is actually paying their fees, then the local authority will be able to recover the VAT that's charged by the school. So it will end up being a nil net effect. HMRC had also confirmed pre-budget that the tour operator's margin scheme would be applied for school trips, which is a particularly nasty set of calculations dreaded in the VAT world. So what do we know now, thanks to yesterday's further guidance? We have had a lot of conversations with HMRC and there's been a huge amount of lobbying by the sector. We've had a little bit more clarity thanks to some of the conversations that have been had with HMRC and the 17,500 responses to their consultation document over the summer. They have now happily confirmed that nurseries can continue to exempt their class fees where they are consisted of wholly or almost wholly children under compulsory school age, which we think would equate to perhaps 90% of the children in that class being under school age and still not having to charge VAT to the entire class. Before and after school childcare and childcare provided in the holiday will also continue to be VAT exempt where it's welfare in nature rather than educational. A concession perhaps for the SEND needs in our society is that the rates relief removal, which will be applied for private schools in England from April of next year, will continue to be available to special schools. So that's a real bonus for those providers. For military and diplomatic families, we've had confirmation that their continuity of education allowance funding will be increased to compensate them for the VAT that they'll have to pay for their children's places. And we've also had confirmation that courses provided in teaching English as a foreign language, where they're provided by private schools, those can continue to benefit from VAT exemption. So there's lots that we still don't know, and some of those points that come to mind are whether school lunches provided for a boarding pupil will be exempt because they're closely related to the supply of education, or seen as part of their taxable boarding fee. We don't know. We still have very little clarification from HMRC about what they regard as a non-business activity for private schools, and those sorts of activities would restrict the amount of VAT that schools can recover. Notably, there's been no commentary from HMRC formally with respect to the treatment of bursaries provided by schools and whether those will be treated as a non-business activity restricting VAT recovery or not. We've also had no clarification at all on how that tour operator's margin scheme will work, when I would argue that school trips can be said to be closely related to the supply of education and should therefore be exempt, not standard rated. On top of all of that, we also don't know what HMRC's general approach is going to be to dealing with schools as they try to VAT register. So, time now for another poll. How much extra revenue will introducing VAT on private school fees and abolishing business rates relief generate? We'll just give you a few minutes to pick your answer. 1.6 billion, 1.8 billion, 2 billion, or 1.4 billion. You've still got some answers coming through. Okay, so just by a nose, 1.8 billion, which is the correct answer, is the latest estimate from the government that will be generated by this change on a yearly basis from 2029. So a little while to go before they start to see that increased tax take. So just very briefly and finally from me, there was no mention whatsoever that VAT registration threshold would be changed, and therefore it will remain at 90,000 for a 12-month period. And it would be remiss of me not to pick up on what Duncan was saying to us about double cab pickups. Just to say that there's been no suggestion at all that the VAT treatment of these will be changed. So it looks as though from April 2025, we'll be entering an era where we have got a discrepancy between how VAT treats these vehicles as opposed to how direct tax treats these vehicles. So c'est la vie. And with that, I will hand over to my colleague Dominic, who will talk to us about business tax.
Thank you, Gilly. Good afternoon, everyone. The starting point for corporate taxes is always corporation tax rates, and these are going to be maintained at the current rates for the tax year 2025 to 26, and indeed for the duration of this Parliament. As ever, the first part of that is dealt with through the Finance Bill. The latter part is included in something called the Corporate Tax Roadmap, which the government has published, which I will come back to later, but may take on the role of being an important document. That means that the corporate tax rates are, as shown on the slide, main rate 25%, small profits rate 19%, and the marginal rate applicable between the those two thresholds will apply. In addition to the actual tax rates, there has been a change. It's not a new change. It came in with effect from 1st of April 2023, but is taking on more significance as time passes, and that is the change from considering 51% group companies to considering all associated companies under common control, applying both for the purposes of the division of the tax rate thresholds, and also the thresholds that determine when companies will pay their taxes through the quarterly instalment payments regime or the very large quarterly instalment payments regime. And the upshot of that is we're expecting more and more companies to be in a position where they're paying their tax earlier through quarterly instalments. Some welcome confirmation in the area of capital allowances. The full expensing relief is to be preserved. That is applicable for companies only, was introduced on the 1st of April 2023 and applies to qualifying capital purchases. So it provided and provides 100% upfront capital allowances for companies investing in new qualifying plant and machinery, as opposed to the 18% writing down allowance which would otherwise apply. It also provides a 50% first year allowance for qualifying special rate pool assets, as opposed to the rate of 6% reducing balance which would normally apply to those assets. It only applies to new unused assets, it doesn't apply to cars, and it doesn't currently apply to equipment acquired for the purpose of leasing to someone else, although that does appear to be one of the areas which is under consultation. Another welcome confirmation was the preservation of the annual investment allowance. Now, the AIA provides 100% upfront capital allowances on the first £1 million of qualifying spend. Now, although it coexists with the full expensing allowance, it can still be beneficial because the balancing charge which arises on the sale of fully expensed assets does not apply in the case of the AIA. It also provides 100% relief in year one for special rate pool expenditure, whereas you will recall that full expensing only gives a 50% first year allowance in that case. And lastly, AIA does apply to unincorporated businesses, sole traders and partnerships, rather than merely companies. One area where we do have change is with a targeted measure which has been introduced in relation to the loans to participators provisions. Now, as many people running an owner-managed business will be aware, corporation tax is payable at 33.75% on loans to participators, which broadly means loans to shareholders and their associates. This is, however, only a temporary tax charge in most circumstances because it will be repayable following repayment of the loans to the company. The basic loans to participators are always supplemented by numerous anti-avoidance provisions already, which catch arrangements which would otherwise escape the scope of the legislation. However, HMRC have become aware of avoidance arrangements involving groups of companies and associated companies which sidestep those provisions and therefore are making changes to counteract this. Part of the reason for mentioning this is that although this legislation clearly has an anti-avoidance intention, the complexity of the current rules already means that they catch various situations where tax avoidance is not in point. The new legislation may also have the effect of causing some collateral damage to arrangements that are not within the policy intention of the provision, but we will see. These changes apply from 30th of October yesterday, but in many respects could apply to arrangements that are already in place. And the message is that even greater care will be required in relation to shareholder loans going forward. So then we come to the forward-looking aspects in relation to consultations and the corporation tax roadmap. There will be a consultation to review the effectiveness and value for money provided by land remediation relief. There'll be a technical consultation on draft legislation covering 3 areas of the UK's international corporate tax legislation, so transfer pricing, permanent establishments and the diverted profit tax. Then there's a potential trick and a potential treat in relation to transfer pricing. The trick is the potential removal or limitation of the current exemption which applies for SME businesses from the ambit of transfer pricing legislation. That may be narrowed, but conversely, they are also looking at possible removal of UK to UK transactions from the ambit of the transfer pricing legislation. So that would be the treat. And I guess the most likely outcome, if change is made, is to carry out both of those steps, which would then revert us to a position similar to that which we had some years ago before we had to abolish the UK to UK TP exemption. There'll also be a consultation on reporting of cross-border related party transactions, which would, one assumes, equip HMRC with more information to assess whether the international tax provisions carry out their function effectively. And lastly, and having had a little bit of time to reflect on what has been published, there are a number of positive commitments in the roadmap to preserve various existing rates and reliefs, and there may be some scepticism about that because many of the things that are in there are not areas where we expected any change anyway. So what has the Chancellor actually given away? But when you look at them, they do include some of the most attractive aspects of our corporate tax regime, and therefore I think providing that the roadmap is adhered to, this is a welcome development. Other measures, I won't go over these in any detail. These are all measures that have been covered in other aspects of this presentation, but I think it's fair to point out that for companies and company owners, those measures will have a considerable impact. So you have the changes to capital gains tax rates, business asset disposal relief, changes to the treatment of employee ownership trusts, all effective from budget day, the increase in national insurance contributions and related changes to employers' NIC, the restrictions to business property relief, and last of all, amongst the package of compliance measures, the increase in the rate of interest on late payment of taxes, which make it all the more important to try and accurately quantify tax liabilities and settle them when they fall due. Lastly, it falls to me to briefly cover changes to stamp taxes. Stamp duty land tax, SDLT, has seen an increase in the higher rate surcharge for additional dwellings, known as the HRAD, which applies an extra 3% where additional dwellings are required or dwellings are acquired by companies. That moves up to 5%. That means that the top rate of SDLT on residential property on the slice system will increase from 15% to 17%, and of course it will impact at all levels of the slice system as well. In line with that, the flat rate of SDLT applying to acquisitions of high value dwellings by companies will also move up from 15% to 17%, and a high dwelling in this case means £500,000. The above rates will be even higher where you have a purchaser who is UK non-resident for these purposes and therefore exposed to that additional surcharge. And these rates, I'm pleased to say, are effective from today, which makes them properly a Halloween surprise. More mundanely, there is the usual uprating of the ATED charges, annual tax on envelope dwellings, which are uplifted by inflation with effect from 1st of April 2025. And with that, I need to pass you back to Sally.
Thanks, Dominic, and thanks for all the presenters. I have to say that was fantastic. Hopefully that is the last of the Halloween puns now. Before we move on to the questions and answer session, just mention some of our upcoming events. We have the FD forums coming up in Ipswich and Norwich next month, and also we are doing a joint seminar with Beckett's Financial Services, which is planning for succession and retirement. And I shouldn't forget as well, we have the VAT training for independent schools webinar as well next month. So there's lots going on. I'm sure a lot of what we've talked today, how that will impact on businesses and schools, will be covered. So if you're interested in any of those, then please go to our website and there will be details in our events section. So I'm pleased to say we've got some questions coming through. Probably head to Jordan and go back to the session on private client. There's been a few queries coming in which we will go through. So the first one is just understanding the interaction of the £1 million allowance that you talked about, which is obviously in respect of business property relief and agricultural property relief, and whether that's in addition to the nil rate band thresholds that people already have.
Yes, so that is in addition, but it's only for assets that qualify for APR and BPR. So yes, whilst it is in addition, you do have to have those assets that qualify.
Okay, so leading on from that, we've had another question that's come through, and it's just asking if you can run through how APR works, which will actually be the same as how BPR works with nil rate bands. So are the nil rate bands used before the balance of the estate is considered for APR, BPR?
Yes, so APR is actually used first before we then consider the nil rate band. That is our current understanding. So I will caveat, we haven't seen the actual legislation yet on this, but that is our understanding on how it will work. So first you'll take your APR exemption allowance, and then you'll use the nil rate band on whatever's left over.
Okay, excellent. So then going to you, Duncan, there's a few questions coming through. So somebody's querying, could employers set up a pension salary sacrifice scheme to reduce the employer's NIC?
Thank you, Sally. Yes, is the short answer. You can. You can currently, and you will be able to in the next years as well. There is no problem doing that. You've got to remember that salary sacrifice is a legal agreement between the employer and the employee to reduce an employee's salary, and it's legally effective. And it's then replaced by the employer paying pension contributions, and you will save tax for the employee, national insurance for the employee, and national insurance for the employer by doing that. There is an annual allowance for pension contributions, and that means employer and employee contributions cannot exceed the annual allowance. So provided contributions are within the annual allowance, it's fine.
Excellent. Okay, and now a question around, again for you, Duncan, about benefit in kinds on the double cab pickups. Is it going to be suffered by employees in their 25-26 P11D, or are they covered by the grace period?
No, if you have a van now, a double cab pickup, which is a van, or if you acquire one before the 6th of April 25, then you've got the 4-year transition period. So your benefit in kind will be based on a van. If, however, you are given a double cab pickup from the 6th of April 25, then it will be a car, and your benefit in kind will be calculated on the basis of it being a car. Whichever it is will appear on your form P11D for 25-26. So it all comes down to when the employer acquires the double cab pickup and when it's provided to you. If that's all before the 6th of April 25, then it will be for a maximum of 4 years a van benefit.
Okay, thank you. Lots of questions coming through. One for you, Gilly. If you have paid school fees in advance, oh, now somebody else has had a question, it's moved, bear with me. So it's around, oh, the question has disappeared. Oh yeah, so if you paid school fees in advance, i.e. all your school year 2024-25, will they still be subject to VAT after the 1st of January?
It depends when they were paid. So if they were paid ahead of the 29th of July 2024, there's a possibility that they will still be exempt, so no VAT to pay. But that assumes that the fees in advance terms and conditions that you signed up to and that your school has implemented do meet whatever the requirements are, which HMRC are likely to look at a later date. Now, if you paid those fees in advance after the 29th of July, then HMRC's anti-forestalling legislation has said that they would be subject to VAT, I'm afraid.
Okay, thank you, Julie. Another one for you, Duncan. Will salary sacrifice for pensions be included in minimum wage calculations?
No, is the short answer for that. So whatever you have reduced your salary to is what you're going to be paid, and that is your minimum wage pay.
Okay, thank you. One for you, Jordan. Hopefully another, maybe a short answer. Have there been any changes to VCTs?
No, there is no announcement to any VCT changes in the budget. Same applies for EIS schemes as well. The only announcement is that they are continuing in their current guise until at least 2030.
Okay. And probably looking at the time, maybe the final one, there's still more questions that we won't get time to cover today, so we will make sure that we come back to you outside of the webinar, but I don't want Dominic to be left out. So final question for Dominic. Somebody's concerned about the expansion of the charge on loans to shareholders. They've got a loan from their company on which my company is paid section 455 tax. Are they going to be affected by the changes?
Yeah, hopefully I didn't set too many hairs running with my comments there. I think whilst we don't know the full details behind that, it sounds like that's a fairly plain vanilla loan from a company to a shareholder on which the section 455 tax has been paid, and therefore I can't see any obstacle to the repayment of that tax being forthcoming following repayment of the loan. It is more complicated arrangements than that will potentially be caught.
Excellent. Thank you, Dominic. So conscious that time, we said we'd finish at 1 o'clock. Don't want to overrun. So say we will come back to people that have raised questions that we haven't had a chance to answer. So that just leaves me to thank everybody for joining us. As I say, we've had high numbers, which I think is a testament for the fact that there were lots of announcements yesterday. Please do contact us, follow up afterwards at the email address if you've got any further questions. But say thanks for joining and have a good rest of your Halloween.